I'm Jeffry Bartash, economics reporter at MarketWatch. Hello to everyone and welcome to Barron's Live, the MarketWatch edition. With me today is Thomas Hoenig. He's the former president of the Kansas City Federal Reserve and now senior fellow at the Embarcadero Center at George Mason University. Tom believes high U.S. inflation stems in large part from a novel strategy the Fed adopted in 2010 to try to juice up the economy. He warned about the consequences of the Fed action at the time in a series of lone dissents. His arguments have found a wider following today. Just recently, Politico did a big magazine spread on Tom and called him a doomsday prophet. Welcome, Tom.
Thank you. It's good to be with you, although I don't particularly like my new title.
Understood. I hope doomsday is not fast approaching.
Yeah.
You believe the Fed made a big mistake more than a decade ago to help plant the seeds for the worst U.S. inflation in 40 years. We'll get to that mistake in a bit. But first, what do you think the Fed is going to do to combat inflation? A key short-term interest rate is near zero, and the central bank has amassed a huge stockpile of government bonds and mortgage-backed securities.
Well, I think there's a little bit of context that needs to go around that. I'm not sure the Fed knows exactly what they're going to do yet because, number one, I think they're expecting, perhaps hoping, that there'll be a moderation in inflation without any immediate intervention, and that is they're hoping that the supply chain issues become less of an issue, and also COVID becomes less of an issue. So that helps the supply side. On the demand side, government programs that involve the unemployment and supplemental income and tax credits have run off, so the demand should moderate. So I think they perhaps are hoping that inflation will moderate to some degree. However, at the same time, to the extent that inflation does remain, and it will, around 5% or so, they will feel, I think, compelled to raise rates, depending on what they see with the inflation between now and March, either a quarter or a half a percentage point. Half a percentage point if it stays in the 6 to 7% range, maybe less than that, if not. Because the FOMC, at least I think the chairman has a bias, if you will, in the sense of the trade-off between addressing this inflation and the fear of unemployment rising. They would be very concerned about unemployment rising, so they would err on the side of inflation. So I expect modest increases in the interest rates, maybe a half point the first time, depending on what inflation does from there, quarter points for 2 or 3 times following that. And then beyond that, I'm not sure anyone knows. It'll depend on how inflation and the unemployment rates proceed into 2023.
So you expect the Fed to raise benchmark short-term rate 3 or 4 times this year, but next year you think it's too early to say?
I think so. And even this year, whether it's 3 or 4 times will depend on how the numbers turn out after the March actions.
The Fed doubled its ownership of bonds during the pandemic to almost $9 trillion, in an effort to drive down long-term interest rates, and they succeeded. Just how quickly and how much do you expect the Fed to shrink its balance sheet?
I think they'll be very slow in shrinking their balance sheet because it is quantitative tightening as opposed to quantitative easing. So it will bring a tightness to the market. It will, if they were to let that run off quickly, it would affect the housing mortgage market because they buy a lot of mortgage-backed securities. It'll affect the liquidity in the market from government securities. And they're going to be very, I think, uneasy about that. They don't want to do it too quickly, although they know their balance sheet is way out of line. But I think we're talking not even a few years. We're talking probably a decade before they can really get that balance sheet brought back to any kind of balance. And part of it will be the economy will grow into it, and part of it will be some modest reduction in their own balance sheet. But I don't expect any real drop of any consequence in the near term.
Let's travel back in time. You were the only member of the Fed's senior leadership to dissent in 2010, 8 times, when the bank began a then controversial strategy known as quantitative easing. That is, the Fed bought trillions in bonds to drive interest rates down, stoke demand, and boost the economy. That was the working theory. Put simply, the Fed created more money, a lot more money, You contend the roots of high inflation now trace back to that decision. How so?
Well, I think, first of all, my objections to the quantitative easing at that time were not just because of price inflation. I thought it might come. I thought in 4 or 5 years. But my concern was in terms of bringing interest rates to zero and pushing that much money into the economy to be deployed. I was concerned about asset inflation. Asset inflation had been a problem in the 80s as the economy adjusted, and I was worried that this would encourage, if you will, speculative activities. It would encourage a significant increase in asset values, including the stock market, housing, real estate, which all of which happened. And my concern about that was then that you're going to benefit some arbitrarily. So if you own an asset, you win just from the inflationary effect on that asset. If you're moderate in asset holdings, a wage earner, you're going to fall behind. You may not see an actual decline in your real wages, but you won't see a significant increase and anything like what you see in the asset value increases. So I was concerned about that. But also then putting that kind of, shall we say, monetary quantity of money in the economy, I think did in the long-term risk inflation. And we're seeing some of that now. But even what we're seeing now is also related to some very significant government spending programs. So it's the asset value, the maldistribution effects for the economy benefiting asset holders over others, the speculative activities that it encouraged and that we saw take place in terms of markets, stock markets. Those were the things I was concerned about then, and I would continue to be concerned about today, given the size of the balance sheet now is $9 trillion. And we've had zero interest rates for far longer than I think were called for on the part of the pandemic.
You touched on this briefly in your last response about maldistribution of income. You contend that the Fed's policies have made the rich richer and the poor less well off. Can you amplify on that?
Well, if the stock market doubles in like 8 years, probably less than 8 years, you have to be an asset holder. You have to be in that market. And usually it's the upper middle, wealthier who are in that. If you are in real estate and you have whether it's commercial, which you gain more, or even housing, you will win from that asset appreciation. But if you're trying to enter the housing market, you're a young person, you're trying to get into that market, it's far more difficult for you. You have to borrow more, you have to commit more of your income to the housing, which was done. And those are the sorts of things that I think affect the distribution of wealth in the economy, where you arbitrarily pump up assets versus what can be earned through the wage mechanism. So that's what I mean by that. And I think those are the effects it's had. And it's caused, I think, some dissension in the public as they've looked at some who've arbitrarily won and others who have barely held their own.
Now, your reading of events suggests inflation in the past decade could be actually much higher than the official numbers report. Consumer prices rose less than 2% a year on average from 2010 to 2020. Assets, as you noted already, soared. The Dow Jones Industrial Average surged 260% from the start of 2010 until the end of 2021. And home values have skyrocketed and corporate debt has hit record levels.
Yes.
What is the danger of this asset inflation?
Well, the danger is what we're seeing today. So the Congress in this last go around increased our debt by about $7 trillion from pre-pandemic to today. It's now $30 trillion. This debt is being spent. A lot of it was transferred in terms of what I said, unemployment, which is, I understand the COVID, very necessary, supplemental income that went even to the middle class, and then other programs. So that's being spent. And so now we're seeing inflation for the first time, 7%. Well, as you get inflation rising, then it puts increasing pressures on the central banks, on the Federal Reserve in particular, to address that. And the way you address that is you increase interest rates. And as you increase interest rates, you get the reverse of the stimulus. You get, I think, Interest rates go up, so the value of the stock market will be under pressure, as we've already seen just by announcing it over the last month. We've seen the stock market correct. There's more perhaps to come if they actually begin to raise rates to bring inflation in. And then the hard part begins, because when that happens and the economy begins to slow, they'll worry about recession. And then worrying about recession, there'll be a very likelihood they'll ease policy again, even while inflation remains above 4 or 5%. And therefore, you will precipitate another, shall we say, asset increase and reverse the gains on inflation and have higher inflation still until you finally have to face up to it. And that's the experience we had in the 70s. I don't care to repeat it, but it is a danger if, in fact, we see the economy slow and the Federal Reserve backs away from its tighter policy and returns to a quantitative easing, more quantitative easing, or something similar to that. So it's going to be a very difficult couple of years or more ahead for the U.S. economy and for the Federal Reserve.